some are facing some trouble. Maybe you could call it distress.
Look at that segment.
That is so beautiful. Let me get back to my notes here. So it says multifamily distress volumes hit 12-year high. My first bullet point is, what are we really even waiting for? I think that a lot of people got excited about distress the minute that interest rates started going up in 2022. They started looking forward to that. Unfortunately, we had, well, or fortunately, depending on who you are, instead of this kind of bonanza of distress and cheap properties for everyone, no one loses. We had low sales volumes and prices that really didn't go down as much as maybe people thought would. It just was not a landscape where you were scooping up deals left after right. That being said, there is a growing amount of loan delinquencies and some interesting trends that they highlight here in this Cred IQ report. I use this. I think that the delinquency trends here are a little bit stronger than the loan loss trends. So here are the delinquency trends. You can see how it's going up. So there was a lot of delinquencies in March of 2010, and then it slowly tapered to really a low point right before the pandemic, and now they're increasing again.
Did something happen around 07, 08, 09, 10?
Don't worry about it. Read it in history books. It's a Great Recession, sorry. Great Recession, Great Financial Crisis, the housing crisis, all of those. It resulted in some difficulties. You can clearly see in this chart, and that would be my the only thing I'd be curious about is how much is what the landscape of loan delinquencies looked like before 2007. But that's fine. I still really, I think that the data they have here is still really helpful. And then you see the multifamily loan loss trends are, they're less pronounced now, but they are still going up. And what I wanted to illustrate here was not necessarily the line graph, but this table of data that they have here for the loan. So it's multifamily delinquent loan balance trends. Right now, the number is $6.11 billion in delinquent loans. And if you go back in time, so now we're 2019, you have to go all the way back to the beginning Q1 of 2012 before you get back to 6.69 billion. And 2012 was the tail end of the delinquent loans associated with the Great Financial Crisis, the fallout there. Mm-hmm. And that's also important to note. Like I said, these long-term trends. That spike lasted several years. It was 2009, 2010, 2011, and 2012. Really, that was a long hill. Like, that took several years, and it didn't exactly go up and then go back down. That was long. Now, I don't know if this is a blip or not, but it does seem like we are building towards something again. So the low point is and they color code this to make it really nice. The colors are green for very low loan losses, yellow for medium, and then we go to orange and red for the high loan losses. Now, right now, so in 2015 to 2019, we were in that green period. Everything was nice. We were kind of at the low point when it comes to loan losses, and then it steadily got a little more yellow. In 2020, got a little more yellow, and 2021, the loan losses increased. So we're talking the low point, 1.09 billion, maybe 0.96 billion, let's say about that. And now in 2 years, so 2019, sorry, let's restart here. 2019, 0.95 billion. That's pretty low. But then 2 years later, we are getting into 2.2 billion. So that's double. And now 2023, we're getting to 3.42 billion, and 2024, 3.6, 5.6, 6.1. It seems like these numbers are getting higher. Am I going crazy? Are they not? Are these numbers going to go right back down, or are we seeing the start of another long-term trend towards increasing loan delinquencies?
I don't know how long-term, but no, I don't think it's going to be an overnight situation where these loans become where there's less delinquency. But what is difficult for a lot of operators, and I think many to their frustration, is that there are plenty of people that would be in the delinquent or underperforming category. I mean, there are plenty of operators that did not know what they were doing, and they bought at a bad basis, or they had a bad
used
business
floating
plan,
rate loans, and now their
right.
interest rates are high, and they also may not be the best at operating. So,
but at the same time, there are plenty of people that would be in the underperforming or delinquent camp where they know how to run a property. They executed their value add plans perfect.
Yeah.
They got the rent growth. They did like everything on their pro forma, their underwriting that they planned to do, that they said they were going to do. They did. The debt just went up on them.
Yeah. Things that are happening through the fault of people and through no fault of their own.
Right.
Yeah.
And I think, when we were at the NIAP event 2 or 3 weeks ago, George and Cam at CBRE highlighted a property that they were that they had sold or were selling in Iowa that faced that faced
Some
was in that
borrowing
exact situation where they
were doing it right, but yeah.
and they faced a debt situation. And then there's also plenty of people that just did not know what they were doing across the board and forecasted 30% rent growth. And so, I don't think that that's going to go away because there are plenty of people that are, as we kind of highlighted at the top of the show, there's still plenty of people that are like, hey, if rates go down, there's a way out of this. And there's the potential for what people seem to think is kind of this extended pretend period.
Yeah. I'm curious about, so this is outstanding delinquent loan balance this is CMBS loans as measured by, or as recorded by CoStar. I'm sure they pulled their data from somewhere. So you can see that there is a kind of spike in the end of 2024. Maybe it's going down now. Now, this is all some estimates for when you get up to closer. However, it does look like it's rising. Now, they have it for the last 5 years. So, and if you go to back to Credit IQ, let's see, it seems like you're seeing the same thing. I mean, it does look like that same increase, and we'll have to see.
But it's also correlating to when people were purchasing these loans.
Yeah.
And especially doing short-term solutions in 2020 and 2021.
Yeah.
23,
so
24,
it's what you invest in.
were,
And sometimes it's where you invest. Sometimes it doesn't even matter where you invest. You can get caught on the wrong side of things. And that was what was interesting about this other article from Credit IQ, where it lists the top 50 markets by Credit IQ distress metrics. This report looks at the top 50 markets that are maybe the most technically or emotionally distressed. They have, this is delinquent or specially serviced loans. So we can pull up let's look it up. What does it mean to be for a property to be distressed? I made a little bit of spelling errors there, but here we go. And let's let the AI answer. It's a distressed property is facing financial or physical challenges. No, I'm looking for a technical definition. That's fine. I've got to move forward. Let's talk to you, Addison. You're a person. And what do you see? What do you see when you look at this list of 50 markets that are ranked by the amount of delinquent or specially serviced loans? The distressed rate on the top one is 49.7, and on the bottom one is 0. So big range here. Is there anything that you pulled out here? Anything you thought was kind of interesting?
Yeah, one of the things that has been kind of top of mind, and it seems like it's been the narrative of the last 2 or 3 years, is a lot of your Sun Belt markets like Phoenix, Miami, Nashville, Dallas. They've some would say are overbuilt, but that's where a lot of supplies happen. It's where a lot of people went to buy. They bought at high bases, I should say.
I want to throw. I want to stop you just right now. I want to define distress as you can't pay your loan anymore.
Go for it. Yeah.
All right. That's where I want to throw down. I'm sorry. I realized that I did not submit my definition there. So I just wanted to say that before. Okay.
What really stands out to me is the kind of the markets where you would think, all right, this probably attracted some developers that probably went into a market more on a field basis than anything.
I was
surprisingly don't really have as much of the delinquency issues as one would think.
Mm-hmm.
And to go back to what I had mentioned on the previous topic or on the previous page,
Mm-hmm.
where people performed just fine and they still had trouble. You would also think that there are plenty of people in these markets in Phoenix or what have you, where based on kind of the demand and how many transactions and everything was going on, you would think that the heightened supply and in some cases subdued or negative rent growth would have really caused issues. And at least by this, it does not appear
not at all
to have been the case. So that was the eye-opening. That was
just
more
how
of the
much
eye-opening thing.
different regions are kind of spread out all across here. There doesn't seem to be a hugely clear pattern here of like, you'd think maybe all the overbuilt Sunbelt markets would be distressed, but they're not at all. The number one is Minneapolis, which may not be a surprise to some people because they actually have built a lot in Minneapolis, which has reduced rent growth. But that's 49.7%. And Providence, I have not heard a similar narrative in Providence, but that's 45.4% of delinquent or specially serviced loans. So Minneapolis, Providence, these are in the Midwest. Chicago, 28.9% delinquent. Now you go back down to the very low ones. You already mentioned Phoenix, which is only 4.6% delinquent. Where is it? Austin, 3.9%. Now that is almost synonymous with oversupplied, low rent growth market, but not delinquent. They're still paying their loans. And same thing with Raleigh. However, and this is super weird too. So it's not just that all the Sunbelts are doing great, because let's go over to Charlotte. That's actually 21.9% delinquent. Indianapolis, Midwest, healthy, great, stable rent growth, 17.1% delinquent. We've got to look around and see if there's some distressed opportunities in our own backyard.
Louisville's at 12%, down to 24%.
Yeah, so the huge. I was surprised not only by the range. Again, we're talking 49.7% for Minneapolis versus 0% for Salt Lake City. But the fact that some of these, a lot of these Midwestern markets are higher than you'd think, or at least they're just dispersed throughout the entire list. Cincinnati is at 16.8, but on the other hand, Columbus is at 1.3. Kansas City is where is that? Kansas City is pretty low. Wait, what did I have here? Kansas City 2.6%, but Milwaukee's at 23%. So wherever you shake it, I would be super interested to see why, what the reason for all of this is. But that's going to involve probably a little bit more complicated research. I'll have to contact some experts at Credit IQ, particularly the author of this, who is Michael Haas. I'll have to see if he can sort out the reasons why. I can't find a regional pattern here. I always like it when there's a regional pattern. I especially like it when it shows how great Midwest is, and I can't find that here.
No, the only thing that I can think of, and this is just thinking out loud, is I don't really have concrete numbers to say it either is or definitely is not this. If you're in a market where a lot of people developed and it was done by merchant builders, where they were able to build, get the property up fast, and then sell, enough of those deals could have taken place where some people saw, I think this is where floating rate debt picture is going to happen. They got on fixed rate enough. If you have the transaction volume going on, you either have people that aren't yet delinquent, or they saw the writing on the wall and got themselves on a debt structure that they were going to be able to manage. Whereas some markets where maybe the development and the new supply didn't catch up. Yeah. But
that's interesting.
I don't know. I mean, Minneapolis got to it on development, and they're high up there, and some of these other markets aren't. So that kind of negates everything
I know there's no part. I'm gonna have to look and see what and if you know, and if you're a listener that knows, leave a comment here on the video or on the podcast. I'd love to learn here. But it is I think you should start looking at some of these with high numbers, and maybe we'll get a deal, because they're not necessarily correlated with the strength of the market fundamentals. There are some here where it's perfect, like Indianapolis, for instance. The supply and demand story is really positive, and so are a lot of these Midwestern markets. Even like Chicago's not doing too bad either, but they're high on the delinquency. So maybe that means there's a deal just around the corner that you'll find for us, Addison. That's what your job is. That's not my job. That's not my job. My job is to congratulate you when you do it. And let's get to it, Addison. All right. Thank you so much for joining the Gray Report. Addison is going to find us a deal in the next 30 minutes, and we'll have updates on that. But we'll see you next week. Thank you so much for staying with us. See you next week.